Hey friends, I'm here. Today we're going to be looking at Kinross Gold, ticker symbol KGC. The company was beaten down for 2 decades long, but it broke through its long-term downtrend last year. So the question is it a good time buy? Or are these gains that we've seen just glitter and not gold? To answer this question, we will look into its business model, revenue growth, profit margins, debt levels, and finally, whether it's undervalued. Let's get right into it. Number 1. Business model. What does Kinross Gold do? In simple terms, the business model of Kinross Gold is to discover, develop, and mine gold deposits around the world and then sell them at a profit. But there are 3 aspects of this business model which I find interesting. First, exploration and development. This is the stage where they are finding new places to potentially mine for gold and expand existing gold mines that they have. It requires a lot of expertise to understand geology and where gold is likely to be found. Second, mining and processing. This is where they actually extract and refine the gold. This includes managing complex operations, ensuring safety, and minimizing waste. And third, sales and hedging. They typically sell their gold at prevailing market prices. However, they also often use something called hedging. In plain English, imagine you own a pumpkin patch, and you are worried that next year pumpkins might become less popular. You could enter into a contract with an orange juice company to sell them your entire harvest for the next year. At today's prices, this is essentially what hedging is. The company enters into contracts to sell gold at a predetermined price, regardless of how the market is performing. This strategy helps to stabilize their income, but it also means that they may miss out on higher market prices. So in short, when you buy gold from Kinross, you are getting a piece of their hard work and risk management. Now moving on to its financial metrics. First, let's look at the revenue growth. Revenue grew a whopping 41.7% year over year, reaching $6.07 billion. This sharp rise is mainly due to 2 factors. Firstly, the price of gold increased significantly during the period. Higher gold prices directly translate into more revenue for mining companies. Secondly, Kinross Gold achieved higher production volumes thanks to their efforts in boosting mining efficiency and expanding their operations. When a company can produce and sell more gold, it naturally leads to higher revenue figures. Next, let's delve into the earnings per share, otherwise known as EPS. EPS is a measure of a company's net income divided by the number of outstanding shares. It reflects the profit a company generates for each share of stock. Kinross Gold's EPS stands at $1.24. There's been an incredible rebound in earnings, soaring by 151.6% year over year. This substantial growth is tied to both the factors we discussed earlier, the increase in gold prices and higher production volumes. These 2 factors combined have led to a significant improvement in Kinross Gold's bottom line, resulting in higher earnings per share. Another important aspect to consider is profit margin. This metric shows how much profit a company makes as a percentage of its revenue. A higher profit margin is generally good, as it means the company is more efficient and effective in converting revenue into profit. Kinross Gold has a profit margin of 25.18%, which is quite high, especially when compared to other companies in the gold mining industry. The strong margin suggests that the company is able to control its costs effectively, contributing to better profitability. Next up, we have return on equity, or ROE. This metric measures how efficiently a company uses its equity to generate profit. It's a way to assess how well a company is utilizing the money invested in it by shareholders. Kinross Gold boasts a healthy ROE of 23.01%. This signifies that the company is using its equity quite efficiently to generate profits, which is a positive sign for investors. Last but not least, debt-to-equity ratio. This is a measure of a company's financial leverage, showing the proportion of debt to equity financing. A lower ratio generally indicates that a company has more equity than debt, making it less risky. Kinross Gold has a low debt-to-equity ratio of 0.16, suggesting that the company is using very little debt to finance its assets. This low ratio indicates that the company is financially conservative, which is a good sign for long-term stability. And before we move on to the next part of the video, if you like this type of analysis, please consider subscribing, as it really helps support the channel. Moving on to valuation. What is Kinross Gold worth? We're going to use two main approaches to value Kinross Gold. First, discounted cash flow, or DCF model. This approach values a company based on the present value of its future cash flows. We will use a conservative estimate of 10% growth rate for KGC since it's a cyclical commodity stock. We will also use a discount rate of 10%. For our terminal growth rate, we'll use 2%, which is typical for mature mining companies. Using these assumptions, the DCF Fair Value estimate for Kinross Gold ranges between $24 to $27. This suggests that the current market price of $20.94 per share is undervaluing the company by 15 to 30%. The second valuation approach we'll use is the Peter Lynch EPS growth model. Lynch was a renowned mutual fund manager who developed this model. This method is straightforward. We multiply the current EPS by 1 plus the growth rate to get the next year's CEPS estimate. Then we divide the result by the required rate of return. In this case, we'll use 25% growth rate for KGC, which is still conservative given its historical growth rate of 151.6% year-over-year. Using this model, the fair value of Kinross Gold comes out to $31 per share. This implies a massive upside potential of almost 50% if the company can sustain its current growth rate. However, it is essential to note that the PEG ratio for Kinross Gold is not published. This means that the market is not currently valuing the stock based on its growth. So there's no guarantee that the current valuation will remain accurate if the growth rate slows down. In conclusion, the analysis of Kinross Gold reveals some compelling insights. On one hand, the company has demonstrated strong revenue and earnings growth, healthy profit margins, and a solid ROE, indicating robust financial performance. Moreover, its low debt-to-equity ratio showcases financial stability and strength. On the other hand, while the DCF and PEG models suggest undervaluation, it's essential to recognize the risks associated with the gold mining industry, including gold price volatility and potential political risks in mining jurisdictions. Furthermore, the absence of a published PEG ratio highlights a need for continued monitoring of the valuation, as growth rates can significantly impact the stock's value. So should you buy Kinross Gold right now? My personal view is that Kinross Gold is looking very promising. It has broken out of a 20-year downtrend, and its fundamentals are looking strong, however, as the stock has already seen a nice rally. I would personally wait for a pullback to a more attractive price level before making any investment decisions. Also, I would keep a close eye on the gold price, as it is a key driver of the company's margins and profitability. Overall, Kinross Gold seems to be undervalued, but it's important to consider the risks and monitor the gold price before making any investment choices. Thanks for watching, and I'll see you in the next one.